My name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The recovery we saw in late July, up from the combined supports of the congestion formed from the lopsided diamond pattern between 1300 and 1180 over October to December 2021. Incidentally, within this diamond pattern are the two 50% Fibonacci lines of the April 20 to February 22 move at 1289 and the May 2019 to February 22 move at 1275. Anyway, this recovery, well, to put it lightly, and as a minimum, this recovery kept beans in the teens. However, the pullback up has been awkward, to say the least. Prices effectively failed at the February to date 50% Fibonacci line at 1532 and dropped back down through the long moving average, currently at 1531, plus the change gap, and down through the 50% Fibonacci line of December 20 to February 22 move at 1451. Interestingly, it was only the congestion zone made up of the lesser Fibonacci levels at 1400, 1389 and 1378 that finally halted the fall in mid-August, turning the market back up, though not by much if compared to the size of the original decline. I want you to remember those numbers again: 1400, 1389 and 1378. Prices punched up through the 50% Fibonacci line at 1451 in late August, peaking on the 24th of August, with not only an indecisive spinning top, but also being capped at the time by the declining short-medium moving average, currently at 1431. The subsequent dip in early September once again found support from the congestion between the lesser Fibonacci lines at 1400, 1389 and 1378. This time, the resultant rally punched up through the declining short-medium moving average into some fairly free air above, all the way till just short of the slowly ascending long moving average, currently at 1526, where the market peaked 2 weeks ago with a shooting star pattern, type 1 bearish. Interestingly, the subsequent decline after this peak was somewhat half-hearted this time, with prices only managing to get down to the 50% Fibonacci line of December 20 to February 22 move at 1451, where they tried once again to move higher, if also in a slovenly manner. Last week I described this behavior thus, and I quote, "I think I can explain the lack of decisiveness on the part of the market. You see, the long moving average, the resistance last week, is rising and would be a good corralling resistance in an otherwise bullish move. However, a new factor has entered the frame. From above we have the declining medium moving average, that's currently at 1500, which this week has moved down enough to be the first line of resistance overhead. Hence, the market's indecision on whether to test or not this new factor. At the moment, one can surmise that the market may become pressured from above the medium moving average and from below by the 50% Fibonacci line and short medium moving average. The short medium moving average is currently 1437. This could lead to a possible small spurt of action. But right now, to see what is next, well, it is not easy. I suspect we may see a sideways to slightly higher action, but even saying that, I have doubts as to whether prices can attain the heights of early August just yet." And that's the end of the quote. That pretty much sums the situation we have, with the exception that this past week prices have once again dipped down to those stalwarts below the market. The support from the congestion between the lesser Fibonacci levels at 1378, 1389 and 1400, before bouncing higher this past Wednesday. It seems that the market is currently being held up by these stalwarts of support below and the bearish pressure being applied by the declining moving average from above. And as I speak, we are on the verge of making a daily key reversal down today into that stalwarts of support between 1378, 1389 and 1400, which makes it all very, very interesting. Chicago soybean meal. What we have here is a number of patterns hitting off of each other at the same time, sort of. The immediate patterns are made to date ascending, expanding wedge patterns, something I pointed out many weeks ago. This has now developed, currently at 405.80 to 477.30, though it's not a perfect pattern, having been breached topside just before the last change gap and again today. well, on the downside. Nevertheless, the base of the pattern has held, including this week so far, but it's being tested right now, and I think it may not necessarily hold on a closing basis. Utilizing the neckline of another pattern, it's been using that as a lower trend line, and this is what's being penetrated at the moment. It's the neckline of the huge December 21 to June 22 head and shoulders continuation pattern, and that's currently at 405.80. This second pattern has been the signature pattern here since since last year, and it resonates, as you can see, even today. It has the unusual, though not unique, feature of a head and shoulders top over the February to April, crowning the head of the bigger head and shoulders pattern. Going back to the neckline, this shallow uptrend has also been the base of a quad and arguably a quintuple, and possibly now whatever the version of 6 is, 6 version bottom, resulting in the attempt higher in late August. Now, going back to the big head and shoulders continuation pattern, when these occur, I immediately look to see as part of the construction of the second shoulder, we see a reverse head and shoulder pattern. And I did draw a prospective neckline for this currently at 461.40. However, the reverse head and shoulder did not really materialize, and instead we saw the formation of a larger upward trend line of the ascending expanding wedge pattern that's currently at 477.30. So, after all of this week, we have a market which was initially sitting amongst the moving averages, now pushing below them and heading to that lower neckline trend line combination and piercing it. Interesting, the last 3 weeks we've seen the moving averages going from 2 pointing up and 2 pointing down, a classic indicator of an indecisive trend, to last week 3 pointing up and 1 just starting to point upwards, an indicator of a bullish incentive building up, to today, this week 3 pointing sideways and 1 slightly upwards, another indicator of an indecisive market. So looking above right now, we still have the change gap at 421.90 to 455.60. This would be the first thing that would need to be filled if any bullish incentive ever is to form up. To be honest, we've previously gone quite a way towards that, but it is worth noting that if the market wishes to do that well, it will still have a long way to fill it. As for trying lower, right, first off, we've got that neckline trendline combination, and after that we have the 50% Fibonacci line of the October 21 to March 22 move at 400.50. My thoughts on tackling this support do not vary from what I've said over the past 2 weeks, and I quote, well, good luck with that. The market has tried that total of 6 times so far since May with no result, and I'll just keep an eye on the parameters of the expanding wedge pattern, as that seems to be the key here, end of quote. But as I say, that lower neckline trendline combination is being tested at this particular point. Be interesting the first few days of next week, I think. See how that goes. Chicago soybean oil. Back in July, the market bottomed out, halting in its decline by the congestion band, mainly dating from as far back as 2011 and 2012, between 57.64 and 59.44. Since then, we've had a gradual ascent, not really obstructed by anything much, passing through the 50% Fibonacci line, the January 21 to April 22 move at 64.09, the long moving average currently 68.62, and the short medium moving average currently 64.79. Interestingly, prices managed to establish themselves over all but the long moving average. At the same time, attempts to revert the market back down have been met with countering bullish moves. Yet this did not stop the market from trying, as you can see by last Friday's bearish open and close along Black Mariposa, which was a countering move to the 4th degree. What was important about this particular move lower was how it was the first clear break and close below the combination of the lower time, currently at 65.76, of the December 21 to June 22 bullish Andrews pitch fall, also acting as an uptrend, and the 50% Fibonacci line of the January 21 to April 22 move at 64.09. This move lower was exploited this week, down as far as the 2011 high at 61 even, before a pullback up to the 50% Fibonacci line. Even this pullback up looks limited, and it would perhaps not surprise me to see a renewed attempt lower. I'll leave the broken bullish Andrews pitchfork on the daily chart for this week, but if that doesn't repair itself, which doesn't seem likely at this particular point in time, if that doesn't repair itself, then it will be removed by my next commentary. Following on from these actions, my thoughts on all this are threefold. Firstly, overhead, we have what I suspect is the stone wall that stopped the rises since July, and the cause of the latest move lower. They are in order: the recent April to July 50% Fibonacci line at 71.97, and a declining medium moving average currently at 68.38. Interestingly, I still suspect that the power now of these two may be diminished a little, as previously they had been intertwined. As we all know, the sum of these together will be greater than each individually. My second thought is more strategic. What if this latest move up and now down is the upswing in a larger June or even May to date bearish halfway hesitation? Now, I have no justification for this pattern just yet, but I speculated upon its existence last week, and with the added data of this week, well, it is worth considering, as in a longer term such a pattern could fit. Of course, it doesn't need to fit, but it could. My third thought is just perhaps, the move lower makes a double bottom, or even a W bottom. For this to happen, we'd need to see how well the congestion band, mainly dating from as far back as 2011 and 2012 between 57.64 and 59.44, holds out. This will now be reinforced by a further smaller congestion band at 56.34, plus the rising April 2020 to date uptrend, currently at 57.18, and the lower time, currently 58.16, of the newly drawn December 21 to June 2022 bullish shift pitchfork. That is the shallower bullish cousin of the steeper but broken bullish Andrews pitchfork. It'll be interesting to see how this all pans out. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.